Today we're going to talk about how to short sell stocks in a bear market. And this is obviously a very popular topic because in a bear market, when everything is going down, people want to short sell. That's theoretically how you can make money on the downside. But before we get into it, I got to give a disclaimer because short selling is not as easy as it sounds. It's not just the opposite of buying a stock. It's a lot harder and there's a lot more risk involved. Because when you're buying a stock, when you're in a bull market, it's pretty easy, right? You buy the thing, it goes up, you sell it. Once in a while, something crazy may happen and your stock might drop 15% overnight. But when you're short selling, it doesn't work like that because a big problem that you got to worry about is short squeezes. And that's when you can quickly get knocked out of your position and lose a bunch of money. And not only that, but the market is always biased to moving higher. So when you're short selling, you're really going against the natural movement of the market. And I know in a bear market, the market is mostly moving lower. But even in that short-term lower downtrend, you're still getting those mean reversions higher. And that's once again when you get blown out of your position. Third thing difficult about short selling is that you're borrowing. You're on margin pretty much. That makes things more complicated and once again you get blown out faster. So keep all of that in mind as we go through this video. You don't have to short sell, but here's how you approach it if you do want to. We recently had a podcast with Robert Prather, who's an investment analyst and the founder of Vision Research. And Vision Research is a fundamental research shop dedicated to finding and alerting investors of short selling opportunities. So of course what we asked him about was short selling. How do you do it? So the way he finds potential candidates to short sell is through balance sheet analysis. So he's looking for those red flags in the balance sheet. And one of those red flags is accelerating accounts receivable growth. Now accounts receivable shows how long a company takes to collect money from its customers. So the company provides a service and how long is it taking for that customer to pay them for that service. So a potential red flag could be accelerating accounts receivable growth, meaning potentially that fewer and fewer clients are paying on time and the company isn't collecting money as fast as they used to. So according to Robert, there's a few common explanations for this accelerating AR growth. The first and most obvious is that the company is having trouble collecting cash from its customers, which signals potential financial operations issues. Another explanation is that the company allows its customers more favorable credit terms. So net 60 versus net 30. So net 60 and net 30, that's basically like you get the bill from the people who did the service, but you don't have to pay it for 30 days or even 60 days. When it comes to business transactions, they give you that flexibility so that your own company can manage their cash flows properly. So companies give longer terms like 60 days instead of 30 to pay them back to entice more business and to sell more products through their channels, which reduces inventory. Robert's final explanation is that the company uses aggressive revenue recognition principles. So in other words, a company claims to sell its products, which it books as revenue, yet it fails to collect the cash for those sales. And if you've taken accounting, you know how much you can mess around with the numbers. You can make things look good when they're actually not good. Like in this case, when you're saying we made the sales when you didn't even collect the money. Because the most important part of a sale is collecting the money, right? But the important thing when you're looking at accounts receivable is that you shouldn't focus on the absolute numbers. As Robert says, absolute AR numbers tell you nothing about the health of the business. Instead, you got to examine those numbers against relative and historical trends. Is it in line with the historical average of this kind of business? Also, compare these figures against industry peers and competitors. This will tell you if this accelerating AR is part of a broader industry contraction or a company-specific issue. And that's what you're really looking for, right? Company-specific issues. And this is a good lesson for markets in general. All these numbers and everything that you look at, you can't look at them in a vacuum. It's always in comparison to something else. It's just like these earnings reports that are coming out for these companies this season. They're pretty bad, but at the same time, stock prices are shooting up because they're not as bad as was expected. So again, you're comparing the actual number to what was predicted, not the actual number by itself. Not the actual number by itself because there's no objective value of that, which is weird because it's dollars, right? But when it comes to stock prices, it's all comparative. And remember, AR analysis is industry specific. So retailers like Gap collect money from their customers at the point of sale. They're B2C, right? To consumers. So they're not going to carry any accounts receivable on their balance sheets, really. But service and manufacturing businesses, and these are the guys that sell to other businesses, they'll have the net 30, net 60 payment terms, so they will have those A&R growth risks. Now the second red flag you want to look for is rising inventory levels. Now this could indicate some potential issues, but you got to ask yourself a few questions. First of all, why is inventory piling up on the balance sheet? What's going on in the business to explain the increase, and is this industry-wide or company-specific? We're getting this question again, right? Because if something's affecting a whole industry, then you're going to see all the stocks in that industry get hit by it, obviously, right? And that tells you it's more of a cyclical thing. Or, again, it's an industry-wide thing, so you shouldn't be shorting just one of the companies. companies. So you want to separate that out and find when it's just a company specific problem, because that's going to give you the signal to short that specific company because they're doing something wrong. So for inventory balances, you can use Apple as an example. Suppose they build a new device to sell in 2 years. So under those conditions, it would make sense to see Apple's inventory expand as they ramp production to sell that product. So in that case, rising inventory wouldn't be an issue because you could explain or justify what's happening. But if you can't explain why it's happening, well, then there's two main consequences of those rising inventory levels. First, there's going to be future product discounts so they can move all that inventory that they got stored up. And there's going to be a slowdown in future production because they're going to have too much stuff to sell. So product discounts obviously reduce the amount of money a company collects on its products. And production slowdowns increase the per unit fixed operating costs. So it costs a certain amount of money to get those machines running, and you want to produce as much as you can while they're running. Otherwise, it's not efficient, and that's when you're losing money. So both of these things reduce margins because they're expensive. And just like accounts receivable, inventory is also industry specific. So like a software business is not going to carry any inventory because it's software. And same thing, it's going to be different for online marketplaces too. So you got to really look at the industry. A third red flag you may find is growing accounts payable balances. So accounts payable is kind of the opposite of accounts receivable. Accounts payable is what the company that you're analyzing, how long does it take to pay off their vendors and the stuff they're buying. So if this number is growing, it gives you a good signal that cash flow is a problem at the company, potentially. So companies that are growing their accounts payable are taking longer to pay their suppliers and vendors. Now, once again, the growing AP balances aren't a bad thing in isolation, so you got to ask yourself a few questions. For example, what are the average days payable in the industry? How long is it taking competitors to pay people back? And are the current days payable higher than average for this business? So it's once again comparing to the industry and comparing to historical averages of the company itself. So a good way to analyze how that specific company is doing is take the average days payable for the company's competitors. Plug that number into the current company you're analyzing and see what the cash flow generation would look like with this new days payable number. When you plug in the average, will the company be generating a positive or negative free cash flow? That'll tell you how the company is doing. Now let's go over some factors that Robert plugs into screeners when he's looking for these short candidates. There's a few things he wants in his short setups. First thing, liquidity. Does this stock trade enough so that I or my clients don't get squeezed? Because like I said before, those short squeezes are a problem. So when you're measuring liquidity, it includes metrics like days to cover, short interest, and borrow costs. So days to cover is a metric where you kind of see how much short interest there is, or how many shares are already sold short, and you compare it to the daily average trading volume. So if everyone had to buy back all those shorted shares, how long would it take? How many days? And again, it's just an estimate based off the volume. So that's the days to cover. Then short interest, you already know how many people are short, and of course the borrowing cost to get short. So Robert prefers shorter days to cover, smaller short interest ratios, and lower borrow costs. And the reason he likes smaller short interest ratios is because when there's large short interest ratios, they're more likely to have a squeeze happen. Next thing he looks at are growth rates. Can he find companies that are moving from low growth to no growth environments? So Robert actually avoids high growth, high short interest short ideas because that's just more complicated trying to predict their revenue growth if a business currently grows at 40 to 50%. And they're too popular. So if you have high short interest, again, you could get those squeezes. So the lower growth companies are usually the boring and more underfollowed, and they have smaller short interest, so they are easier targets. Another thing he looks for is their earnings quality components. And we've already discussed those components earlier in this video, like the growing accounts receivable, the growing inventory, the increasing accounts payable. Those are all factors to look at when you're looking at the balance sheet. And finally, he looks at perception and reality gaps. What are the current market expectations and how close or far away are they from reality? So Robert tries to understand what the market is currently pricing in terms of margin expansion and revenue growth, and then judges those assumptions against his version of reality. So this perception versus reality gap exists if the market's future expectations for earnings growth and or margin expansion overstep rational business assumptions. So correct predictions on that gap allow a short seller to benefit from multiple compression. Basically, if the market is pricing something too perfectly and the earnings multiple is too high, then you could see that collapse. Now, like I said, short selling can be very dangerous, so one thing you definitely want to have in place is your risk control. And in this video right here, we talk about risk control strategies in a bear market. So if you're going to try and short sell, you're definitely going to want to watch this video too. So click it and I will see you there.